Now there is another very big mistake that every other forex trader does. If we have to draw a pattern on the 4-hour time frame, one of the most problematic and confusing aspects of trading is time frames, like which time frame to use, how to shuffle between different time frames, and so on. For example, look at this trade setup. It looks like a good shorting opportunity. We were with the trend, a nice rejection from the EMA confluence zone, and so anyone would have entered a sell trade from here. Well, if you do go short from here, look how the price moved up. Now you would say that it's always advised to go with the trend, and here, even after being with the trend, the price moved in the other direction. Well, that was because on a higher time frame the trend was bullish and it was just a test of the trend line of this pattern. Now let us take this example. Here there was a breakout in a 1-hour time frame, and so anyone would have entered a buy trade from here. But see how the price moved back down into the pattern, and this happened because on a higher time frame there was no breakout yet. That is, the candle did not finish outside of the pattern. And this was the same thing that you saw at the start of the video, and I'm going to explain this very important thing later on in this video, which will save you a ton of money. Well, these are some very common issues that every other trader faces and end up confused about which time frame to use for trading and to be with the trend or to not be with the trend. And the answer to all of this is multi-time frame analysis, because multi-time frame analysis can solve this. And in this video I will tell you what is multi-time frame analysis, the concept behind it, and a step-by-step process to perform multi-time frame analysis. So let us get started. Let's start by understanding what is multi-time frame analysis. But before that, we are just 991,400 subs away from 1 million subscribers. So make sure you subscribe to Forex Monopoly and help me reach 1 million subscribers. Now, multi-time frame trading is more like a trading method that traders use, where they use not just one single time frame to make trading decisions, but they rather use 2 or even 3 time frames to make trading decisions. Like if they need to enter a trade on 1-hour time frame, they will check with a 4-hour and daily time frame so that if the trade is valid. And I will tell you how to do that, but before that you need to understand why we use multiple time frames, and there are these 2 principles that if you understand properly would solve all of your doubts. The first principle is that a higher time frame dominates the trend and needs something very strong to change its trend, but the smaller time frame is easily affected by anything and everything, which means that the trend on a higher time frame is more important than in a smaller time frame, and it cannot be easily changed. That is, a trend on a higher time frame cannot be easily changed. And this also means that if you wish to be with the trend or trade with the trend, then always look at the higher time frame and based on it take the trades. Like in this example, if you see on the 5 minutes time frame, the price was creating lower lows and low highs and indicating a downtrend. So to be with the trend, you would have looked for a sell entry, but see how the price moved up because the trend on the higher time frame is bullish. This also indicates that the lows which you thought were a downtrend was just a pullback to a higher time frame trend. Whenever we look at the higher time frame, we get a clear picture of the main trend. Now, the second principle you need to understand is reversals start from a lower time frame and move to a higher time frame. And this again is very important principle, and if you see, most of the time the reversals start on a smaller time frame and then move to a higher time frame. So using multi-time frame analysis for finding a reversal can provide you with an early or a sniper entry. But again, the most important thing is for that reversal to occur at important levels on higher time frame like daily or weekly. Like let us say that there is a resistance on a higher time frame. So what will happen is the price will start showing signs of reversals on lower time frame, and on a lower time frame the price will create some sort of a pattern or start to create highs and lows or give any other indication that the price is now reversing its trend. And this will help us to understand the situation very quickly, and it will also help us to act on it quickly, hence providing a better entry. Though this type of entry is very risky and needs you to have a proper experience, but this is something which is very important when you are trying to flip accounts, and I use it all the time when I do the flipping account challenge, because the RRR provided by this, that is the risk to reward ratio provided by this, is insane. So now that you know why we use multi-time frame analysis, let us see how to perform multi-time frame analysis. We are going to use multi-time frame analysis for 2 different purposes. The first one is for continuation entries, that is trend writing entries, and the second one is for finding sniper reversal entries. But before we move forward, there is a thumb rule that you need to follow, and that is do not use more than 3 time frames to make a trading decision. And the reason for this is it may confuse you and cause analysis paralysis where you may not be able to make any trading decision at all. Now let us see how to use multi-time frame analysis for riding a trend or trading with the trend. Let us say that you wanna use multi-time frame analysis on USD JPY, and what you are gonna do is you are gonna day trade on 30 minutes time frame. For day trading on 30 minutes time frame, or for looking for any opportunities on USD JPY on 30 minutes time frame, the first thing that you need to do is move 2 time frames higher. That is, if we are on 30 minutes time frame, then you will go for 4-hour time frame. And then when you move to 4-hour time frame, what you have to do is you have to check for the trend of this pair. That is, you have to check what is the current trend of USD JPY on 4-hour time frame, because we are using a higher time frame to see what is the current trend of the current currency pair. So if we see on USD JPY 4-hour time frame, the current trend that is on 4-hour time frame is bullish. That is, the price is in continuous and a very strong bullish trend. So the next thing you have to do is you have to move to 30 minutes time frame, and now you have to be aware that any movement that goes against the trend is just a pullback. That is, the price is in a strong uptrend. So if you can see, the price is continuously creating higher highs and higher lows, higher high, higher low, higher high, higher lows, and it is also respecting the 200 and 100 EMA. That is this confluence zone over here. So anytime the price drops nearby this level, you have to look for a buy trade. And you also have to remember that here in this chart, on no matter what time frame you use, you have to avoid these counter trade movements. That is, now if you are day trading this time frame, what you will do is you will look for only buy entries, no matter if there are sell entries, like the price moved down from here and this is a rejection from 0.618 Fibonacci level. But no matter what it is, you have to only look for a buy trade, and that is how you are going to be with the trend. So what you can do is you can go to 30 minutes time frame and then look for patterns or any setup that you use which is providing you with buy entries, and only take buy entries in an uptrend. Now let me give you an example to show you. So let us move to this part over here. Okay, so if you can see, the price was moving up over here, and if you needed to day trade from this level, let us say from here you decided to day trade USD JPY on 30 minutes time frame. So what you will do is wait for the price to drop a little more, or let us say if you are using Fibonacci, then you will connect it from this low to a new high, and then you can see how the price rejected the 0.618 level. That is a bullish candle, and then you will enter a trade over here, and you can see how the price moved up. Now in this case, there have been a lot of sell trades over here, but as we knew, on a 4-hour time frame, the trend is up. That is, the price was in a strong uptrend. So we have to avoid all the sell entries, because those are counter trade entries, and there will be a lot of resistance faced by it, and it's of no use to go to trade counter trade entries in such a good trend. So this is how you look for continuation entries. Now there is another very big mistake that every other forex trader does, and that is they do not trade continuation patterns breakout properly. And what I meant to say is, let us try to understand by this example. So if you can see, the price was in a downtrend over here in this chart. The price moved down till this point, it moved up, moved down, moved up, moved down, and then we saw that the price somewhat broke out of the pattern. That is, this candle was finished out of the pattern. So what traders do is they enter a sell trade over here, as this was a bearish flag. So they will enter a sell trade over here, but then you can see how the price moved little down, but then it moved up and would have took the stop loss. Now why this thing happened is they do not use multi-time frame analysis over here, because while trading patterns, that is a breakout of continuation patterns, what you have to do is you have to look for the highest time frame in which that pattern is valid on. I always say this, that whenever you trade patterns, always look for the highest time frame on which that pattern is valid on. Here, if we move to the 4-hour time frame, you can clearly see, just a minute, yeah, you can clearly see over here that the pattern here is valid on 4-hour time frame. If we have to draw a pattern on the 4-hour time frame, the pattern would look something like this. right? The pattern would look something like this. As the price moved down here, rejected, moved up, pattern moved down till here, then again moved up. And now you can see that this is, the candle has not finished over here on the 4-hour time frame. Like on 30 hours time frame, we saw that the price moved below this line. But on a 4-hour time frame, the price did not move below here. And so it was just a fake out, and then the price moved up. So the real entry will be when the price break out of this level on the highest time frame it is valid on. Like the highest time frame this pattern is valid on. So in this case, this pattern is valid on 4-hour time frame. That is, 4-hour time frame is the highest time frame in which this pattern is valid on. So when it breaks out of the pattern on the 4-hour time frame, that is when you enter a sell trade over here. You can see a pole, then a flag, that is a bearish flag, and it broke out on the 4-hour time frame, and then it moved down. So multi-time frame analysis will also help you to save a lot of money and help you stay away from the false breakouts. And it will be the same way like I showed you in this example. Now let us see how to trade reversals using multi-time frame analysis. Now, like I told you earlier, that reversals first occur on the smaller time frame and then it moves on the higher time frame. It's just that we need a very important area or a pattern on the highest time frame so that we can then use lower time frames to take trades. In this case, let us see how to trade reversals. So here we are on gold US dollars daily time frame. So as you can see over here, the price first rejected this area and then it dropped down. And the movement over here is not small because the price almost dropped. If we calculate it, the price almost dropped around 17 to 18%. So that is a big move indeed. And so this is a very strong resistance for gold. The next time when the price moved up, you can see how the price rejected this and then dropped down sharply, right? So what you have to do is you have to first find such areas that is on higher time frame, and then you have to only find important areas to which the prices really reacted. And it can also be patterns. It's just that in this example, I'm taking a resistance to show you how to do that. So after you have marked the resistance, the next thing that you have to do is move to smaller time frames, like let us say 4-hour or even 30 minutes time frame. So when we move to 30 minutes time frame, you can clearly see that over here the price was creating higher highs and higher lows, higher lows, and then the price could not create a new higher high, right? The price created this flag like structure and then it retested it and then it moved down, right? In this case, if we would have traded this on daily time frame, we would have got an entry, let us say, after this engulfing candle over here. But if we use 30 minutes time frame, and the reason why we are doing is this resistance is very, very important. We are not entering just in between of an uptrend. We are entering at a very crucial point, and that is very, very important to remember. So if you would have entered over here, our entry would have been at the breakout of this. So let us say you entered over here, and then your take profit could have been easily around of 664 pips, which is a massive risk to reward ratio. In this case, your risk would have been around, let us say, 200 pips, and your take profit is almost thrice of it, that is 600 or 700 pips. Now again, then the price again moved over here, it created a pattern, and then it again broke out of it, and you can see how clearly it retested it, and then again it started moving down. Now here, the reason why we are not waiting for the price to give us a confirmation that the price is now gonna reverse or the trend is reversing is because here what happened is this is a very, very important area on weekly and also on daily time frame, and that is why we are able to use lower time frames to find those high risk to reward entries by using it, by combining it with the higher time frames. So what we're doing is we are finding areas or patterns on higher time frames, and then we are going to lower time frames and then using it to find strict and tight stop loss entries. This is how you use multi-time frame analysis, and these are the benefits of it. I hope you enjoyed this video. If you did, then make sure you hit the like button, and also do not forget to subscribe to this channel. Thank you so much for watching.